York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump reinstates the U.S. blockade of Iranian ships, saying the U.S. will become, quote, guardian of the Strait of Hormuz. Brent climbs to above $87 a barrel now. Rate hike bets rise. Expectations for a July hike increase ahead of CPI data and Fed Chair Kevin Warsh's testimony on Capitol Hill. And a big day for big banks. 5 of the 6 largest released results before the opening bell. All right, it's been a huge evening already around the world. Let's get straight to where the action has been pretty volatile. Let's get over to Hong Kong now and Winnie Su for the latest.
Yeah, morning, Bonnie. It's been indeed a very volatile day in Asia. Now we have MSCI Asia slightly towards the upside with the Kospi, in fact, reversing earlier losses. And that, of course, is driven by how South Korea's SK Hynix rebounded after having fallen about 9% earlier today. So we are seeing foreign investors buying while retail investors continue to sell as investors continue to weigh how far this AI rally can really go. Now, when it comes to currency space, we do see South Korean won strengthening to its strongest in about 2 months, driven by those foreign flows and the dollar when it comes to the ADR listing of SK Hynix. Now you flip the board and take a look at Japanese assets because the bonds really in focus. We have yields falling across the curve after those comments from the finance minister Katayama saying 2 things. That one, they will potentially consider adding JGBs to Japan's tax-free NISA account, and also that the pension fund GPIF will be adjusting portfolios as needed. So that has also supported the stronger demand for the 20-year bond auction today.
Winnie, an awful lot going on across Asia. Thank you so much for the update. That's Winnie Su there in Hong Kong. Now let's get over to London and to Justina Lee. Justina.
Good morning, Bonnie. Now, it's an update for oil, so of course it's a down day all across European assets, with the Stoxx Europe 600 down 0.8%. But all the biggest moves here are in the bond market, with the UK short-end bond yield up 7 basis points and the long end up 5 basis points. Now, what I find really interesting here is that we're seeing way bigger moves in UK bonds today than in German bonds. For instance, on the long end, the German bond yield is basically not moving. But if we kind of want to see what's driving all this, we just need to flip the board here to look at expectations for rate hike by the BOE by the end of this year. And we can see a big move recently following that oil move, with traders now pricing in 2 more 25 basis point hike by the end of the year. And it's the same in Europe. And it seems like we're seeing some similar movement in the U.S. as well, Bonnie.
Yes, particularly after Governor Waller's comments. We'll get to that in a moment. Justina Lee, thank you so much. This is the oil picture. We're above $87 a barrel. A fresh U.S. blockade, a demand for what some may call a toll, a 20% reimbursement on cargoes from countries that are transporting those cargoes. And then we just had a fatality. A seafarer on a UAE-flagged ship was killed after the UAE boat was struck. And all of that together, combined with more strikes on Iran and fresh rhetoric from Iran as well, pushing Brent up to 87 and change, and New York crude up to 81 and change. This is getting to be a little more testy, a little more humid, if you like. Humidity definitely rising. And you can see it in European gas futures as well. 50 handle now. All of last week when this was just percolating, European gas futures still were at a 40 handle. Let's take a look at other asset classes, because we also had Fed Governor Waller talking about a near-term rate hike. Markets immediately thought, oh, this month. Now, whether that means this month or not, we don't know, but they're certainly pricing it in. Equity index futures are mixed, as you can see. NASDAQ 100 futures mirroring what happened in Korea were lower, now they're higher. But for the Russell 2000 and the S&P, we're seeing fractional declines. And then those yields, because let's get to those yields. We have CPI data, we have big banks coming out with earnings. Look at this 2-year yield, 4.28. This is the highest we've been since February, not of this year, but of last year, February of 2025. So a massive rise in yields. We have a 30-year yield at 5.10 and change, but the 2-year yield is really where the action is at after Governor Waller's comments. And of course, before we hear from the Fed chair himself in front of the House today. All right, let's get to some individual market movers now before the opening bell with Chloe Mele.
Good morning, Bonnie. We are seeing Apple weaker this morning after the company was downgraded by KeyBank analysts, with the analysts saying that they see weaker demand in the US going forward, and that means that the estimates for iPhone sales might be actually a little bit too ambitious. So we're down about 1% this morning for Apple. Moving on to tech, which is seeing a bit of a rebound this morning. We are back in the green for the likes of Micron, Intel and Nvidia. We saw Hynix shares rebounding and re-injecting maybe some of that positive sentiment around the AI trade, which is translating here into some movements positive movements for some of those tech stocks. And finally, Ericsson over in Sweden is down this morning after flagging that it will see weaker margins because of rising costs for key components, and that is really weighing on the main unit, the networks unit for the company. And so we are seeing quite the plunge this morning for Ericsson, down almost 8% in Stockholm.
All right, there will be plenty of individual movers today, as well as, of course, the macro picture. Chloe, thank you so much. Chloe Melly will be back later in the hour. Also coming up this hour, we look ahead to the CPI data and the testimony with Abigail Watt of UBS. We're going to preview bank earnings with Saul Martinez of HSBC. Brent then up past $87 a barrel after President Trump said the US blockade of Iranian ships transiting the Strait will be reinstated, along with that toll, from 4 p.m. Eastern today. Joining us from Dubai is Bloomberg's Abir Abu Omar. A double blockade, a double threat on tolls, and now it appears just one ship transited in the last 24 hours, Abir. Is that the current state of play?
A very complicated one indeed, Vani. That is what we're seeing. So a double blockade, President Trump saying that by 4 p.m. ET today, that blockade on Iranian ports will be reinstated. He said by 4:45, we'll see other attacks on Iran. Now, let's just bear in mind that Central Command in the early hours of our morning in Dubai had said that it finalized a third consecutive day of strikes on Iran, mainly some of those southern provinces that we've been seeing getting struck over the past few days or so. Iran retaliating in a fashion that is similar to what it has done over the past few months or so when it gets struck by the United States, hitting countries in the region. Namely, this morning we saw Jordan, an airbase there was hit, Kuwait, Qatar, Oman, and Bahrain. We also saw yesterday, Vani, as you have mentioned a little bit earlier in the show, 2 ships from the UAE being hit in the Strait of Hormuz, resulting in the death of 1 person and injuring 8 others. So we're seeing that we're back to a state of casualties as well. But when it comes to the Strait of Hormuz itself, President Trump didn't just say that a blockade will be reinstated. He also said that all other cargo ships that are not Iranian making their way through the waterway will now be privy to a 20% cargo fee. So our teams have calculated that that comes to around $30 million, or at least a little bit north of that with the current oil prices. Now I'm seeing that Brent crude is ticking higher by the second, $87 on the barrel. We did that calculation with the prices of about 85. So we're seeing even that fee coming higher as the day goes by. And so Iran's response to President Trump's new fee was essentially that it will be the guardian over the Strait of Hormuz. It will be the guardian forever, according to the foreign minister of Iran. So we're seeing tit-for-tat attacks happening yet again. We're seeing an escalation when it comes to the Strait of Hormuz yet again. And we're not seeing any clarity on whether those technical talks will go back to, or if we're going to see any of those talks coming back to the table. We haven't heard much from the mediators yet. Up until just a week ago, Qatar was one of the main mediators between the U.S. and Iran. And 2 days ago, Qatar was being attacked by Iran. So we're seeing an escalation in the region for sure. And we're seeing the Strait of Hormuz really coming back into focus with the other concessions in that MOU that was signed about 3.5 weeks ago, Vani, taking a backseat for the time being.
Yeah, and to quote Zia Daoud in the Dubai office, our chief emerging markets economist, President Trump's war with Iran has now turned abundance into a squeeze. This toll might be a new supply shock. Abir, thank you so much. Abir Abu Omar there. Meanwhile, traders are ramping up bets for an interest rate increase later this month. 2-year yields surging ahead of today's CPI data and Fed Chair Warsh's semi-annual testimony before Congress. Bloomberg senior editor Alistair Bull joins us now. Alistair, if the CPI data is hot today and we've seen the move that we've seen, can the Fed hold?
No. I think it's quite clear from the body language from Kevin Warsh's statements during the press conference last month that he's going to be very committed to getting inflation back to 2%. Now, our forecast is for CPI to actually tick down, to cool. And that would give him an opportunity to hold if he wants to. But I think that there's another argument here, which is if you get a benign reading on CPI, I think you'll hear the chairman say today, we need more information because we're going to defeat inflation. If it's hot, I think he isn't going to explicitly say they're going to hike, but he's going to leave no doubt that that's the direction in which they're heading. And a hike in July does two things. It establishes his credibility as an independent Fed chair who's going to be hawkish, who's not going to be afraid of defying the president, who, as we know, wants to lower interest rates. And it's also going to spare him the tricky task of, if he doesn't go in July, of having to hike in either September or October as he gets closer to the midterm elections. And you know, that's going to cause an awful lot of pressure from the White House, from the Republican Congress, if he hikes into those elections. So there's a lot of good reasons to think that July is live and is on the table. Now, if you get a hot print, I think that those odds for a rate increase are going to escalate. And if Chair Warsh sees a hike fully priced into markets, it's kind of unlikely he's not going to use that opportunity to go. Finally.
Yeah, to say the markets interpreted the data, and indeed that's how we've interpreted it too. If the committee does hike in July, Alistair, will the markets take that as a sign that a new hiking cycle has started? Or could it be one and hold?
So it could be one and hold. This could just be an insurance cut. And again, it's going to depend on the data. There's a lot of smart people out there who think that the Fed will hold all year if the data come on side. You mentioned the speech yesterday by Governor Chris Waller. He laid out two cases. One reason, cases for why inflation would remain benign and the Fed could stay on hold, and cases where the spread of higher prices into goods and service prices means they're going to have to tighten in the near term. But he used that expression in the near term, which is sort of code for an insurance hike, a one and done. So I think that possibility would remain very real in the market's minds, depending on what then happens with the data. But as we've seen in the last few days, oil prices are up above $80. It's very hard to have any high conviction about the course of inflation and the course of monetary policy. Bonnie.
Yeah, and it's amazing how the MOVE index rose as well. It's the market repricing in an instant. Alistair, thank you so much. It's getting to be an exciting time again. Bloomberg senior editor Alistair Bull there. It's also a big earnings day. 5 Wall Street banks releasing second quarter results. Analysts expecting the best second quarter ever when it comes to trading revenue. Joining us now is Bloomberg managing editor of EMEA Finance, Tom Metcalf. So, Tom, who's going to win out on equity trading revenue?
Yeah, well, it seems like Goldman might well break the record. They only just set the last quarter, so they're expecting, or we're hearing, they might top $5 billion in revenue from those stock traders. But yeah, broadly speaking, all these banks were expecting to kind of release pretty strong capital markets results. So absolutely, I think stock trading will be most front and center. It's probably going to have the most eye-popping numbers. But you've also got deal makers kind of, really leaning into this M&A surge. And then, of course, just generally, the US economy continues to sort of move forward, and at least at the top end, the bit that these kind of high-tier banks tend to see, it's all guns blazing for corporates and stuff like that.
JP Morgan is an interesting one because it's expected to come out with industry-leading results, right? Fortress, Diamond, and so on. Yet the stock is underperforming the other banks crazily. It's up something like 3.5% this year. Is it underperforming, Tom? I mean, even year over year, it's not performing like the other banks.
Yeah, I think it's somewhat disappointing, but I'd probably just keep in mind that the bar for a JP Morgan is so high, given over the years it's had such a sort of run-up, I suppose. And of course, Diamond is a bit of a master of sort of taking some of the steam out of these things when he thinks perhaps, even for his own stock, things have sort of got ahead of themselves. But yeah, I mean, that will be the first ones to report today, I believe. And, as ever, they'll probably set the tone. I'm personally expecting a pretty strong set of results, so I would think maybe that sort of share price performance ticks up a little bit at least today.
Absolutely. Tom, cannot wait for this barrage of earnings today. That's Bloomberg's Tom Metcalf. Now to other top stories trending on the terminal this morning. China exports hit a record $412 billion in June, blowing past estimates. Global demand for AI pushed exports 27% higher than a year ago. Imports rose the fastest in 5 years. Japan's finance minister is floating the idea of adding government bonds to Japan's tax-free investment program. The proposal aims to draw more money into domestic markets as the yen hits record lows. DeepSeek founder Yang Wenfeng is now the world's richest AI model creator. Yang's net worth more than doubled after the firm's most recent fundraising round. He's now worth $36 billion, up from around $17 billion, putting him well above Anthropic's Dario Amodei and OpenAI's Greg Brockman. Coming up, extreme volatility gripping AI darling SK Hynix. We look at this morning's whiplash in that stock next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. SK Hynix is higher after shares of the South Korean memory giant tumbled since its U.S. trading debut Friday. Not just that, but at one point today they were down 8%. Let's get a read on what exactly is going on here with Matt Bloxham, senior analyst at Bloomberg Intelligence. I mean, a 16% swing, you might see that in a meme stock, Matt, but in SK Hynix, what happened? What's happening?
Yeah, I mean, obviously there are jitters around the outlook for the AI trade and, whether the memory chip companies really can break this kind of boom-bust cycle that we've seen many times before. Personally, I think what we're seeing here is kind of really more the kind of secondary effects, the mechanics, if you like, of these kind of leveraged ETFs. And, obviously the US ADR has kind of brought an extra dimension into that whole swing trade too. So, yeah, nothing really about fundamentals. I think it's more about levered ETFs kind of balancing their positions on a day-to-day basis and the complexity of that ADR adding into the mix.
It also means that the Kospi's intraday swings are getting more violent, though, and that can't be good for market stability in Korea. And then, the markets that follow on.
Yeah, that's right. And obviously, I think that a number of people have been calling for kind of greater regulatory interventional scrutiny, and whether there's been perhaps too much of a kind of free market philosophy and how many of these levered ETFs have come up, and maybe there will be some additional guardrails that come into place. Obviously, been even some talk about that these kind of instruments should be banned. I doubt they'll go that far, but certainly it's kind of brought to light perhaps some need for some kind of more kind of some mechanisms to make markets a bit more orderly.
Yeah, I mean, in other crises, there have been extraordinary maneuvers. There was no short selling on certain stocks at one point. Remember during the GFC. Interestingly, we just got a story saying Samsung Electronics is not reviewing the possibility of issuing ADRs. And it's interesting because earlier we were reporting that Samsung was said to be in early discussions and exploring a potential offering in the US of ADRs. Do you think the performance of SK Hynix is causing Samsung to rethink what it might have been thinking earlier?
I guess it's probably certainly had some kind of influence on their thoughts about this. But, I mean, there's lots of complexities for a company to add an ADR program. You suddenly kind of come within the purview of the SEC. So it's by no means a kind of a free and easy ride for a company. And I think, to some extent, you've kind of got the allure of raising relatively cheap equity capital, which is arguably what SK Hynix has done, and opening up the wider US investor base. And, I guess to some degree, perhaps Samsung are kind of taking a balanced view that, they have sufficient access to the international capital markets and they don't need to add the complexity of an ADR program to kind of, boost perhaps the kind of US retail investor base. So, yeah, I think there's probably a lot of things that have gone into that deliberation.
Well, that simplifies things for South Korean stocks for the moment. Anyway, once again, Samsung Electronics is not reviewing the possibility of issuing ADRs, the company said in a comment via text message. Matt, thank you so much. Matthew Bloxham there of Bloomberg Intelligence. Coming up, a look at your front page news. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York, and it's time now for your front page news. First up, the Washington Post reporting a federal judge denounced President Donald Trump's lawsuit against the IRS as an improper attempt to manipulate the courts and legitimize a controversial deal. That deal included establishing a nearly $1.8 billion fund for alleged victims of politicized prosecutions. Next up, the Wall Street Journal reporting data center builders and operators are working with bankers to sell majority equity stakes in their companies this summer. The potential stake sale talks with PE firms coming as owners seek exits and investor interest in owning physical infrastructure grows. And finally, the New York Times reporting the sister of the late Senator Lindsey Graham was appointed to finish his Senate term by South Carolina Governor Henry McMaster. Darlene Graham Nordone accepted the appointment, saying it would be a, quote, privilege to get to finish some of her brother's work. Let's take a look at your markets then this Tuesday as threats just ramp up in the Strait of Hormuz, including a fatality after 2 UAE flagships were struck. We do have Nasdaq 100 futures higher. This as we see a rebound in the semi-trade, particularly in Korea. The 2-year yield, though, at levels not seen since February of 2025 after Governor Waller talked about a near-term hike being a potential, and as markets await Fed Chair Warsh. And New York crude above $80 a barrel. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. President Trump reinstating the blockade of Iranian ships, saying the U.S. will become, quote, guardian of the Strait of Hormuz from 4 p.m. today, Eastern Time. Brent trading around $86 a barrel right now. Rate hike bets rise. Expectations for a July hike increase ahead of CPI data and Fed Chair Kevin Warsh's testimony on Capitol Hill. And it's a massive day for big banks, with 5 Wall Street banks releasing results before the opening bell. So let's get straight to those markets. It's going to be a whippy day. We're already at just under $87 a barrel on Brent. Another round of strikes on Iran, the reimposition of a U.S. naval blockade, a general demand from President Trump for a 20% reimbursement on cargoes from various countries moving them through the Strait. And in fact, no ships really moving at all now, because we had an attack on 2 UAE flagged ships and 1 fatality from that attack. And all this goes to escalating everything, and the price of crude in particular. European gas futures too trading with a 53 handle. Markets, of course, also on edge. We may be looking at a hot CPI print in a few hours. Let's take a look at where futures stand. We had Nasdaq futures higher, S&P futures and Russell futures pointed marginally lower. The Nasdaq rebounding. We had a massively whippy day in Korea, and it's obviously anyone's guess where the chip stocks and the memory stocks trade today. And then yield-wise, a huge increase, particularly at the front end of the curve in the last 24 hours, with the 2-year yield now trading at 4.28, and basically a July rate hike all but a done deal. I mean, unless we get very soft CPI data today, which may give the Fed chair a little bit of leeway, but markets also will be listening to what the Fed chair has to say. Let's get over to London now, and Chloe Melly, you already saw her. She's got some individual movers. Chloe.
Good morning, Bonnie. Indeed, we are seeing Apple down about 1% this morning after being downgraded by key bank analysts, with analysts saying that they expect much weaker demand in the US, and therefore that the estimates for iPhone sales might be just a little bit too ambitious. And so we are seeing some weakness there in that stock. Moving on to technology, which is seeing a bit of a rebound. We're seeing Micron, Intel, Nvidia, SanDisk, all of those US technology names rebounding after SK Hynix shares also rebounded, and there seems to be some positive sentiment being injected once again into this AI trade, and we can see that reflected in those shares this morning. And we've got Micron in particular up almost 3%. And finally, we are going over to Sweden, where Ericsson is seeing a little bit of weakness, actually quite a lot of weakness, after warning that margins would come under pressure this quarter from rising costs for key components. That is really weighing on the networks business, which is the main business for Ericsson, and we are seeing shares down more than 8% this morning in Sweden.
All right, thank you for the steer. That is Chloe Melly there in London. Traders ramping up bets for a July rate hike ahead of today's CPI data and Fed Chair Kevin Warsh's testimony in Capitol Hill and after Governor Waller's speech yesterday. Joining us now is Abigail Watt, US economist at UBS. Abigail, first, what are you anticipating for CPI today, the headline and the core as well?
Yeah, so our expectations, for the CPI print today, I think there's going to be kind of a tale of two numbers. I think expectations are obviously that, given the strong decline we saw in gasoline prices through June, that we should see energy kind of weighing on the headline. So we're expecting that you see the headline down by around 25 basis points over the month. But we do think you continue to see kind of the core CPI, not showing much progress. So our expectations are that you see kind of actually a 21 basis point rise in the core CPI, which is essentially the same as the rise you saw in the May data. So I do think there's kind of somewhat of a tale of two numbers, in the data that we're going to see on the inflation front this morning. And I think, when we think about kind of the kind of composition of kind of core CPI, I do think there's areas where we could continue to see progress. Our expectation is that, we continue to see kind of shelter prices, moving lower. We do think that you're kind of past the peak of the kind of pass-through of kind of tariff pass-through into kind of core goods prices. But I think that, obviously people will be watching to see kind of what we see in terms of kind of some of the AI inflation potentially in terms of kind of the tech components of the CPI too.
Well, if we do get a little bit of an improvement in some of those data, Abigail, would there not be a case for a hold at the July meeting? I mean, markets seem to be absolutely convinced that we're getting a hike this month, particularly after yesterday's comments from Governor Waller. But is Kevin Warsh tied to that,
So I think, we've obviously seen this kind of split in the FOMC. You saw it at the June meeting. We saw it in the minutes last week. And, I think the interesting thing is, we heard Governor Waller kind of harking back to, I would say, kind of some of the scenario analysis that we'd seen in the minutes and the discussion that took place at the June meeting. There's two scenarios here. A scenario where you potentially kind of do begin to see kind of more progress and more disinflation in the data. And that essentially would lead you to kind of remain on hold because you don't want to kind of hike into a situation where you're then going to see the progress kind of coming through. Equally, there is the other scenario, and I think the interesting thing in Governor Waller's remarks yesterday was the fact that he kind of talked to this idea of a potential for a near-term tightening in policy if you were to see kind of the kind of continued kind of pressures in inflation and inflation kind of remaining elevated and not see that progress. And I think the interesting thing in his remarks was this kind of timing element, this idea of kind of the importance of today's data and not just the kind of CPI print, but the PPI data that we'll get and the import price data ultimately, and that essentially, feeding through into expectations for kind of PCE prices, which is really what, the FOMC is targeting. So I think the kind of comments from Waller yesterday kind of really put a lot of emphasis, I would say, on this week's data in particular.
I mean, if we do get some elements of inflation coming in hotter, even if it's, some unexpected ones, we also have that weaker jobs report to think of. So, would it be a conundrum for the Fed chair and for the FOMC committee?
So I think, obviously we heard from Governor Waller yesterday talking about the labour market. And I do think that's an important thing to kind of note is that, when we think about kind of the dynamics we're seeing just now in terms of the rise in energy prices and the potential for kind of broader kind of supply constraints and that influence on inflation, I think a lot of people have been referencing kind of 2022. And I think that was one of the key things that was, came out of Waller's remarks yesterday was just that the dynamics are slightly different from 2022. That labour market outlook, yes, it's been more stable, but the kind of pace of job gains we've seen in the US economy just now is obviously well below the pace of job gains you were seeing in 2022. And I do think that, you have to think of that balance, obviously, between the labour market and the inflation data. But I do think, if you were to see kind of growing upside risk to inflation, potential for kind of broader supply chain disruptions, obviously we've seen kind of more headlines over the potential, kind of disruption again to the Strait of Hormuz. And I think, with potential for kind of broader supply constraints, potential upside from AI demand, a number of these kind of upside risks to inflation, I think it potentially kind of shifts the balance given that stability we have seen somewhat in the labour market.
So obviously, before we get that FOMC meeting, we're going to have the testimony of the Fed chair. I'm just curious what you think we might learn today or tomorrow, given that he won't be likely to give the markets a steer, but he may end up giving the markets a steer somehow.
Yeah, so look, I think the irony is that, Chair Warsh obviously has kind of said he's kind of not wanting to give forward guidance and wanting the markets to focus less on kind of Fed speak. And I think the irony is that, it actually has led to kind of an increased emphasis on, any comments that he does make. And I think markets will obviously clearly be watching, his testimony this morning. Our expectations are that we don't get a huge amount of colour from him. I would expect that, he wouldn't want to kind of prejudge the July meeting. And I think he could kind of, actually also kind of use those words of not wanting to prejudge that discussion. The idea that there will probably be, quite a lively discussion at the meeting around the outlook for rates. I think, in terms of his, characterization and the language that he uses, I think he'll probably kind of, hew very closely to the statement language that we had at the June FOMC meeting. And then I think, he's obviously, I think, going to clearly emphasize, as he did in his kind of Sintra remarks and as he did in the post-meeting press conference, this clear commitment to kind of restoring price stability and restoring inflation to 2%.
He said, markets, you interpret the data yourselves, we'll interpret the data ourselves, right? Is there any danger that if the Fed does move in July, having had this move at the front end of the curve, that then the Fed will be guilty of responding to the markets, if you like, and then the markets will push the Fed further, if maybe for another cut? A hike, I mean.
So I think the markets will be responding to the data, and I think the FOMC will also be responding to that same data. I think it's unlikely, I would say, that you would see kind of a significant difference in terms of the interpretation potentially of kind of the CPI data, I would say, between kind of what the FOMC is thinking and what the market is thinking. I think the key thing, though, will be kind of how the FOMC are feeling around those kind of upside risks to inflation, and whether they feel like now those upside risks are something they need to respond to, or whether they think they would like to continue to wait, have that patience, and see kind of whether you do see that kind of progress and that disinflation kind of coming through in the second half of the year, which, I think, you could see. I do think there's elements of the inflation basket that, should begin to kind of come off, and we should see a little bit less heat in the inflation data through the end of the year. But I think the question is whether the FOMC feel comfortable enough to kind of wait and see.
I mean, Abigail, is it fair to say that we're in a whole new world this week that we weren't in last week before this all kicked off again in the Middle East?
Yeah, look, I think it, obviously we've had a whole conversation here about inflation and the potential for kind of, the supply chain disruption risk to kind of broaden out. And I do think that is obviously an upside risk to inflation. But one of the things we haven't talked about is the potential implications for the growth side of the US economy, right? And I think, just now we've seen US consumers holding up relatively strongly, weathering this kind of stronger kind of price shock from energy prices. And I do think that's largely due to kind of peak fiscal support from, bumper tax refunds that we saw due to the OBBA. Now, there's a potential here that, that kind of peak in fiscal is happening now, and that isn't necessarily something that could be, sustained through the end of the year. So I think that's the other risk here is, obviously there's a lot of focus on the potential implications for inflation, but I think we also have to think about the potential implications for growth too.
All right, well, we will get to that data in the middle of all the bank earnings at 8:30 Eastern. Abigail Watt, thank you so much. Abigail Watt of UBS there. Now to other top stories trending on the terminal this morning. The US-Iran truce collapses. That's after American forces reimposed a naval blockade and launched another wave of airstrikes. Iran targeted US bases in Jordan and Bahrain and hit 2 oil tankers from the United Arab Emirates. DeepSeek founder Liang Wenfeng is now the world's richest AI model creator. Liang's net worth more than doubled after the firm's most recent fundraising round. He's now worth $36 billion, up from around $17 billion, putting him well above Anthropic's Dario Amodei and OpenAI's Greg Brockman. Chipotle is heading to Mexico, betting that an American brand can sell Mexican-inspired food in the country. Its inaugural store will open near Monterrey on Thursday, with a couple other locations planned through 2027. Chipotle will likely face challenges. Taco Bell flopped in Mexico after several attempts because its menu failed to resonate with locals. Coming up, we're going to be taking a look at big bank earnings with Saul Martinez of HSBC. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Big banks are posed for their best second quarter ever. Analysts are expecting a revenue rout from the banks, which are set to report this morning. For a preview, we welcome Saul Martinez, head of U.S. Financials Research at HSBC. So, Saul, give us the highlight.
Hi.
What bank is going to blow us all away and justify this massive run-up that we've had, not in all of them, but in many of them?
Yeah, look, I think they're all going to varying degrees, have good results. I think those likely who have more capital markets exposure and investment banking exposure are probably going to post, really good results. Goldman reports this morning, but I think in that we'd expect a really strong result there. But all in, I think this is a good quarter for the banks, generally speaking. We're expecting median EPS growth of 17% year on year. I mentioned the capital markets results being strong, but I think you'll also see good loan growth, net interest income growing okay, credit quality, doing well. The question, Bonnie, though, is durability. As you mentioned, many of them, not all, but many of them, and in general, they've performed really well. So can the good momentum, can the continued profitability improvements, can the continued upside to consensus EPS revisions, can that continue? I think the quarter is going to be more about sustainability, revenue sustainability. Can the exceptional capital markets results continue? Net interest income, can it continue to grow? And I think the bar is a bit higher. But all in, we think that the banks, broadly speaking, are going to have pretty good results.
There's no danger that we're a little complacent or overconfident in these results. Is there anything that's going to surprise us, Saul?
Yeah, I think we highlighted that in our preview. I think right now investors look at the big picture and say, well, there's nothing that is clearly going to derail the story that we can point to. But that runs the risk of growing complacency. I would say two things that are risks that might show up in the results. I think the first one, which is perhaps more likely, it's not the base case, is net interest income being softer. I mentioned loan growth is good. One of the underpinnings of the positive thesis for banks is that we have positive real rates across the curve, and that's a good thing for net interest income. But the funding costs are maybe ticking up, and you talked to your last guest about monetary policy. Now we're pricing in 2 rate hikes over the next 9 months. So there is a concern that maybe funding costs and deposit costs will start to bite. And if the banks suggest that net interest income growth in the back end of the year is going to be a little bit lighter than it has been, that could be a cause for concern. And then the second thing is capital market sustainability. The markets results, trading especially, has been really, really strong. I think it will be strong again this quarter, but if there's any hint that the second half of the year, which does have tougher comps, we'll see slower growth, that might lead to some pullback and some concern about whether the capital markets results will continue to be a source of strength.
Yeah, I mean, already just in the last few sessions, that 30-year yield is at 5.10, right? So you would imagine that banks will have to have a different answer to questions regarding longer term yields and so on. What about private credit? There's no worries there, right? All across the banks, we've damped down all those worries, and we're not going to find out anything that surprises us.
I don't think so. I mean, I think when we had this discussion last quarter, private credit was very much front and center of the discussion. What the banks did do last quarter that was really positive was that they gave really good disclosures on their private credit exposures. And what it showed is that the overall levels of exposures are low single-digit percentage of portfolios, and that the risk profiles are good. They're collateralized by pools of loans. Advance rates, which are basically the max amount of loans relative to the value of the collateral, are pretty low. So you have to see really big losses in the underlying portfolio for that to be impacting the bank. So I think they'll update the disclosures perhaps, but I don't think it will, you never say never when you talk about anything related to credit quality, but I don't think that will be a big theme this quarter as much as it was last quarter and maybe the previous couple of quarters.
And now to get to the base question of stock prices and where they're at, you have upped your price targets by between 6 and 14% for the various banks. I am curious though, why is JP Morgan only up 3.5% year to date? And as for Wells Fargo, which is your top pick at the moment, I mean, we're down year to date by more than 5%.
Yeah. Yeah, I mean, there's, in the case of JP Morgan, look, it entered the year at pretty elevated valuations, still trades at a premium. So the bar is higher at JP Morgan. I mean, they posted really good results, but the bar is higher. The stock price has done well for an extended period of time, and it trades at 15, 16 times PE, which is a pretty big premium to other traditional banks. So the bar is higher. I think the other thing that on the margin, maybe has impacted them is their net interest income. They didn't increase the guidance on the back of last quarter, and there was some hope that they would. And they are spending. That's not necessarily a bad thing. They are spending, they're investing. That positions them well for longer term growth. But it does lead to a situation where they're the only bank that we cover that is expected to not have positive operating leverage. So I think it's a combination of all those things. Wells Fargo, we did upgrade them to our top pick into the quarter. So this is, Citi had been our top pick for quite a long time. So this is a new, change. This is a change for us. And I think there are a couple things, but the big thing with Wells more recently was the net interest income dynamic. Again, similar to JP Morgan, but more extreme. They really underperformed in the first quarter. They had some pressure on funding costs and net interest income. There had been some hope that they would increase guidance as well, and that didn't come to fruition. And right now there is perhaps some concern about the trajectory there. We think it's going to improve in the coming quarters, that trajectory. We think that will be well received. In the other parts of the story, excess capital, buybacks, loan growth good, investment banking is being built out, capital markets businesses are being built out, the wealth, the investment management business is doing well. We think all those things and a discounted relative valuation underpin why we're more constructive here than we have been for a while.
Saul, thank you so much for giving us some of your time today. Get some coffee and get ready for the marathon of a day that is going to be for you and your team. That's Saul Martinez of HSBC. And stay tuned to Bloomberg all day long for coverage of today's earnings. Wells Fargo CFO Mike Santomassimo will join the close this afternoon. This is Bloomberg. Now a look at what's ahead today, or as much of it as we can get to. 5 Wall Street banks reporting before the opening bell: JP Morgan, Goldman Sachs, Bank of America, Wells Fargo and Citi. Then we get June CPI data that's out at 8:30 a.m. Eastern. And Fed Chair Kevin Warsh gives his first semi-annual testimony before Congress, appearing before the House Financial Services Committee at 10 a.m. This even as war continues in the background. This is your picture. So while the Nasdaq 100 futures are pointed higher, the other equity index futures are pointed lower. The 2-year yield ramped up yesterday after Waller's comments, and New York crude is trading above $80 a barrel.